Hey everyone, welcome back to another video. My name's Sam, and in today's video we'll be diving into some essential terminology that will set you up for the start of your trading journey. We'll break down 10 trading terms you absolutely need to know to navigate the markets with confidence as a beginner trader. But before we begin, we'd like to hear from you. What's one trading term you find really hard to understand? Of course, make sure to stick around until the end of the video so you don't miss out on anything important. Alright, grab a notepad and let's jump right in. First up, let's talk about the bull market. This term describes a period when the prices of securities like stocks and commodities are rising or are expected to rise. Typically, a bull market is marked by an increase of 20% or more in prices. Imagine a bull charging ahead. That's the market moving forward, driving prices higher. During a bull market, traders feel optimistic and are more likely to buy, fueling the upward trend. A big bull market took place from 2003 to 2007, when the S&P 500 went up dramatically after a previous drop. This run ended when the 2008 financial crisis hit, causing major declines. Next, we have the bear market. This is the opposite of a bull market. It's a period when the prices of securities are falling, often by 20% or more. In a bear market, traders tend to be pessimistic, and selling is common. The market moves in a downward direction. It's a time when confidence is low and prices are on a decline. A recent example of a bear market is the one that occurred in 2020 during the early days of the COVID-19 pandemic. Stock prices dropped sharply as the crisis unfolded. Now let's look at volatility. This term refers to how much and how quickly the price of a security can change over time. High volatility means that the price can swing up and down quite a bit in a short period, while low volatility means that the price is more stable and changes less dramatically. It's important to understand volatility because it affects how much risk you might be exposed to. For example, a stock with high volatility might offer high returns but also comes with greater risk. Bid and ask prices are a fundamental concept in trading, representing the prices at which you can buy or sell a security. The bid price is the highest price a buyer is willing to pay for a security, while the ask price is the lowest price a seller is willing to accept. The difference between these two prices is known as the spread, which is essentially the cost of trading and how brokers make their money. For example, if the bid price for a stock CFD is $100 and the ask price is $100.05, well then the spread is 5 cents. A stop loss order is a tool to manage risk. It's an order placed with your broker to buy or sell a security once it reaches a certain price. Suppose you own a security at $50 and you set a stop loss order at $45. Your security will automatically sell if it drops to $45, helping you limit your losses. Take profit order, on the other hand, is an instruction you give to automatically close your position once it reaches a certain profit level. Let's say you buy a stock CFD of $50 and set a take profit order at $70. This means your position will be automatically sold when the stock price hits $70, locking in your profits. This ensures that you lock in your profits without having to watch the market constantly. However, if the stock CFD doesn't reach your target price, the order won't be triggered, and you might miss out on capturing those gains. Think of a take profit order as a way to manage your profits, just like a stop loss order helps you manage your losses. While a stop loss order automatically sells your position to prevent excessive losses, if the price falls, a take profit order does the opposite by obtaining your gains when the price rises to your target. Now, on to leverage. Leverage involves borrowing funds from your broker in order to control a larger position than your initial investment. For example, with 10x leverage, you can control a $10,000 position with just $1,000 of your own money. While leverage can amplify your potential profits, it also increases your risk. If the market moves against you, losses can exceed your initial investment. To get a deeper dive on how leverage works and learn how to use it wisely, check out our full video on leverage where we break down all the key points. Let's move on to our final terms. Long and short positions. These terms describe the direction you're betting on in the market. A long position means you're buying a security expecting that its price will rise. For instance, if you buy shares of a company because you believe its stock price will increase, you're taking a long position. Your goal is to make a profit by selling the shares later at a higher price. Essentially, you're optimistic about the asset's future performance. On the flip side, a short position is when you sell a security you don't own with the plan to buy it back later at a lower price. This strategy is used when you believe the price of the asset will decrease. For example, if you short a security at $100 and the price falls to $80, you can buy it back at the lower price, returning the shares to your broker and then keeping the profit from the price difference. This strategy allows you to potentially profit from falling or bear markets, but losses can be unlimited if the asset's price rises instead of falls. So there you have it. 10 essential trading terms every beginner trader should know. As always, stay informed, manage your risk, and trade responsibly. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more trading tips and financial insights. And if you have any questions, drop them down below. Anyway, here is 2 more videos that you might like. I'll see you next time.